Picture this, October 28th, 1929, the night before Black Tuesday. Millionaires went to bed, rich, and woke up broke. Front page headlines screamed, "Stock crash nets billions." Bankers literally jumped from Wall Street windows. Now, everyone's screaming we're living that exact same nightmare again. But here's the thing, they're dead wrong. And I've got the receipts. What if I told you that every single "we're about to crash like 1929" headline is missing the most basic facts? What if the data actually shows the complete opposite? What if the people screaming, "sell everything," are the same ones who told you Bitcoin would hit zero when it was at 3,000? Stick around for the next few minutes, because I'm about to show you exactly why the doomsday prophets are selling fear, not facts, and why listening to them could cost you millions in lost gains. Look, I get it. Your feed is probably flooded with crash predictions. Some guru with a scary thumbnail and red arrows everywhere told you to sell everything. Your coworker who called the COVID crash after it happened is now preaching doom again. Maybe you're even thinking about panic selling, your fingers hovering over that sell all button. But before you nuke your 401k, before you stuff cash under your mattress, you need to see these numbers. Because the difference between 1929 and today, it's not just big, it's laughably massive. We're talking about comparing a paper airplane to a Boeing 747. All right, let's cut through the noise and call out these fear merchants. Everyone loves a good crash story. It gets clicks, it sells newsletters, it makes nobodies into financial profits. One scary prediction that happens to be right, and boom, you're selling $2,000 courses for life. But you know what crash predictions don't do? Tell you the truth, or make you money. Just ask anyone who listened to Crash Profits in 2013 or 2015 or 2018, or literally every year since 2009. So let's start with what the fearmongers are saying. Here's their greatest hits album, "Stock valuations are sky high." True. Debt levels are massive. Also true. The market's due for a correction. Probably true. Inflation is eating us alive? Fair point. The Fed's lost control. Debatable, but okay. But here's where they go completely off the rails. None of that means we're about to see a 1929-style collapse. It's like saying because you have a headache, you must have a brain tumor. Let me show you why comparing today to 1929 is like comparing a kitchen fire to the Chicago fire. Both involve flames, but that's where the similarity ends. What actually happened in 1929? First, we need to understand what actually happened in 1929. This wasn't just a bad day on Wall Street. This was financial Armageddon on steroids. And I'm not being dramatic. Picture this reality. In 1929, you could buy $1,000 worth of stock with just $100 down. That's 90% margin. Today, the legal limit is 50%, and most brokers won't even let you get close to that. But here's the nightmare fuel. Back then, when your stocks dropped even 10%, you got a margin call. No negotiation, no payment plans, no, we'll work with you. Pay up immediately or get liquidated. Imagine getting a telegram, yes, a telegram, at 2 p.m. saying you have until market close to come up with $10,000 or lose everything. That's like getting a text today saying you have 2 hours to find $300,000. Where do you get it? You can't. Now multiply that panic by millions of investors. When the market started dropping, it triggered an avalanche of forced selling. Real people, teachers, doctors, shop owners, watched their life savings evaporate. People who bought RCA at $100 watched it fall to $2.50. That's not a typo. It lost 97.5% of its value. General Electric fell 89%. US Steel dropped 86%. These weren't fly-by-night companies. These were the Apples and Microsofts of their day. But wait, the horror movie's just getting started. When you couldn't pay your margin call, where did you go? The bank. Except, plot twist, the banks had loaned out all their money for stock speculation too. They were playing the same game, just with your deposits. When people couldn't pay, banks started failing. And here's the part that should make your blood run cold. There was no FDIC, no deposit insurance. Zero, nada. When your bank failed, your life savings vanished. Poof, gone. Not tied up in bureaucracy, gone. Not, you'll get it back eventually, gone. Forever gone. Your grandmother's $500 she saved for 20 years, gone. Your kid's college fund, vanished. That emergency fund you kept for medical bills, evaporated like morning mist. In just 3 years, 9,000 banks failed. Let that sink in. 9,000. Today, we lose our minds if 3 banks have issues, and even then, everyone's deposits are protected up to $250,000. In 1929, you got to stand outside your bank, watching through the windows as employees packed up, knowing your money was gone forever. Imagine the entire banking system of Texas, California, and New York just disappearing. Now let's talk about today, and prepare to feel a lot better about your financial future, because we've built an entire fortress of protections that would make 1929 investors weep with joy. We're not talking about minor tweaks here. We're talking about fundamental game-changing, this changes everything protections. Firewall number 1 is the Federal Reserve in beast mode. In 1929, the Fed literally raised interest rates as the economy was collapsing. They thought they were fighting speculation, but they were basically performing surgery with a chainsaw. It's like seeing someone drowning and throwing them an anchor. Today, the Fed has an arsenal that would make Marvel superheroes jealous. Rate cuts, quantitative easing, emergency lending facilities, currency swaps, repo operations. I could list tools all day. When COVID hit, they deployed $4 trillion in days. Not years, not months. Days. Think about that. In 1929, they did basically nothing for 3 years while the economy burned. In 2020, they had emergency meetings on Sundays and launched whatever it takes mode before most people finished their morning coffee. Firewall number 2 is circuit breakers, the panic stoppers. If the market drops 7%, trading halts for 15 minutes. Everyone takes a breath. Algorithms reset, panic subsides. At 13%, another halt. At 20%, markets close for the day. It's like having a mandatory timeout when a basketball game gets too heated. In 1929, no breaks. Just pure, unfiltered, soul-crushing panic from open to close. Firewall number 3 is the FDIC, your money's bodyguard. This is huge. Your money in the bank is insured up to $250,000 per account. You could have accounts at 5 different banks. That's $1.25 million in protected deposits. In 1929, when banks failed, families lost everything. Today, even in 2008, when giants like Washington Mutual collapsed, largest bank failure in U.S. history, not a single person lost 1 penny of insured deposits. Your checking account was safer than Fort Knox. Firewall number 4 is margin requirements, the speculation strangler. Remember that insane 90% margin from 1929? Today, it's capped at 50%, and good luck finding a broker who will let you anywhere near that. Most require 35% minimum equity. Plus, you get time to meet margin calls, usually 3-5 days. No more pay in 2 hours or lose everything telegrams. All right, data nerds, this section's for you. This is where the fear-mongers hate to go because numbers don't care about your YouTube algorithm or newsletter subscriptions. Let's start with unemployment, the ultimate economic truth detector. In 1929, unemployment was already rising before the crash, and hit 25% by 1933. 1 in 4 Americans couldn't find work. Breadlines stretched for blocks. Today, near record lows around 3.8%. Companies are literally offering signing bonuses for fast food workers. Help wanted signs are everywhere. We have the opposite problem. Not enough workers for all the jobs. But what about layoffs in tech? Sure, Meta and Amazon trimmed fat after hiring like drunk sailors. But zoom out, unemployment is still microscopic. It's like worrying about a paper cut while wearing a bulletproof vest. Corporate profits tell another story. In 1929, profits were already collapsing. Companies were bleeding cash. Today, S&P 500 earnings hit record highs. Apple alone has $162 billion in cash. That's more than the entire GDP of Hungary. Google prints $60 billion in free cash flow annually. Microsoft could buy a small country with its spare change. The banking system has transformed from paper houses to fortresses. In 1929, banks had basically no capital requirements. They were leveraged 50-1, playing roulette with depositor money. Today, major banks hold $2.2 trillion in excess reserves. They undergo stress tests simulating nuclear-level scenarios. JP Morgan could lose $50 billion tomorrow and yawn. Bank of America has enough capital to survive a meteor strike. If 1929 banks were made of straw, today's banks are made of titanium-reinforced concrete, surrounded by moats filled with laser sharks. Market structure has evolved from casino to institution. In 1929, it was mostly individual investors gambling with borrowed money. Shoeshine boys were giving stock tips. Today, 70% of trading is institutional. Pension funds, index funds, 401ks. These aren't panic sellers. They're systematic, diversified, and have committees for their committees. Vanguard doesn't wake up and panic sell because of a scary headline. I know what you're thinking. Your inner skeptic is screaming. So let's address the elephant stampede in the room. But the debt. The government owes over 34 trillion reais. Yeah, it's a big, scary number, but context matters more than size. In 1929, the government couldn't print money. We were handcuffed to the gold standard. Every dollar had to be backed by actual gold sitting in a vault. Today, we control our own currency. The Fed can create money with keystrokes. Japan's debt is 260% of GDP, way higher than ours, and they're fine. Why? Because they borrow in yen, which they print. It's like owing money to yourself, annoying but not catastrophic. But household debt is through the roof. Actually, household debt service ratios, the percentage of income going to debt payments, are near 40-year lows. How is that possible? Because millions locked in 3% mortgages. Even with higher balances, Payments are totally manageable. Your neighbor with the Tesla and the pool, his mortgage payment is probably less than rent for a studio apartment. That's the power of locking in low rates. But corporate debt is insane. Sure, raw numbers are high, but companies are sitting on $2.5 trillion in cash. Apple could pay off most companies' entire debt with their coffee budget. Interest coverage ratios are strong. Default rates are below historical averages. But stocks are expensive. The Shiller PE is 32. True. In 1929, it hit 30. Sounds similar, right? Wrong. Dead wrong. First context, in 2000, during the dot-com bubble, it hit 44. We survived. The market corrected, sure, but civilization didn't end. Your 401k recovered and then some. Second context, the competition for money is changing. In 1929, you could get 5% in a savings account. Today, while bonds and cash accounts are finally paying meaningful interest again, the long-term growth and dividend yields from quality stocks still look more attractive for capital appreciation. It's basic math. Would you rather have a moderate return in bonds or potentially 5% dividend yields and growth from quality stocks? Plus, today's expensive companies actually make money. Apple's profit margin is 25%. Google prints cash. Microsoft has a 35% margin. In 1929, the hot stocks were radio companies burning cash and railroad companies with massive debt, not even remotely comparable. Here's the dirty secret nobody wants you to know. Crash predictions are a business model, a very profitable one. Every time someone screams, crash incoming, check what they're selling. Newsletter, course, gold, crypto, survival food. There's always something. Michael Burry, the Big Short genius, he's predicted 10 of the last 2 crashes. Peter Schiff has called for hyperinflation every year since 2008. We're still waiting. Harry Dent predicted Dow 3000 in 2016. It's at 35,000. Eventually, someone will be right. Stop clocks and all that. They'll claim genius status, do a victory lap, write a book, and milk it for decades. Meanwhile, patient investors who ignored the noise, the S&P 500 is up 500% since 2009. That's including COVID, wars, inflation, everything. Look, I'm not saying markets can't fall. They can and will. Corrections are normal. Even 20% drops happen every few years. But a 1929-style collapse. You'd need mass unemployment, we're at record lows, banking system failure, Federal Reserve incompetence, complete credit freeze, massive forced deleveraging, and no government response. For a 1929 repeat, you'd basically need aliens to invade, the internet to disappear, and everyone to simultaneously forget everything we've learned about economics. Good luck with that. Want to know what actual billionaires are doing? Not the Twitter profits, real money. Warren Buffett's sitting on $150 billion in cash, but he's not selling everything. He's waiting for opportunities. Big difference between keeping some dry powder and the end is near. Institutional investors aren't fleeing stocks. Pension funds are required to hold equities for long-term returns. University endowments are increasing alternative investments, not going to cash. The ultra-wealthy, they're buying real assets, real estate, businesses, art, entire companies. They're not hoarding gold bars and bunkers or buying freeze-dried food. So what should you actually do? Here's your no BS guide. First, stop watching crash prediction videos. After this one, obviously. They're designed to scare you, not help you. Fear sells, but it doesn't build wealth. Second, check your risk tolerance honestly. If you can't sleep at night, you own too much stock. But don't confuse temporary volatility with permanent loss. Amazon fell 90% in 2001. Investors who held are up 15,000%. Third, diversify intelligently. Own some stocks, bonds, real estate exposure, international holdings. Don't put everything in Tesla calls or treasury bills. Be boring. Boring builds wealth. Fourth, build your fortress, 6 months expenses in cash. This protects you from having to sell investments at the worst possible time. It's your sleep well at night fund. Fifth, keep investing regularly. Dollar cost averaging through volatility is how real wealth is built. The best days often come right after the worst days. Miss the 10 best days over 20 years, your returns get cut in half. Here's the truth bomb. The financial media needs you scared. Calm, rational investors don't generate clicks. Everything's probably fine, doesn't trend on social media. But the data tells a different story. We're not in 1929. We have safeguards, knowledge, and tools that didn't exist then. Could markets correct? Absolutely. Could we have a recession? Probably. But a complete systemic collapse that wipes out 90% of wealth? The data says no way. The people screaming about 1929 are selling fear. I'm showing you facts. The difference? Facts don't need scary music, red arrows, and ominous countdowns to be true. So next time someone tells you we're on the night before the crash, ask them, where's the near 25% unemployment? Where are the 9,000 bank failures? Where's the complete absence of safety nets? Where's the 90% margin speculation? Where's the Fed raising rates into a collapse? They won't have answers because they're not analyzing, they're dramatizing for profit. Stay informed, stay diversified, and most importantly, stay calm. The market rewards patience, not panic. Every single person who sold in March 2020 because this is it missed a 100% rally. Don't be that person. Remember, fortune favors the informed, not the fearful. And the informed, they're buying while everyone else is crying.